Hey guys, Chris from Adapt Solution here, and this is video number 10 of my PoA MCQ prep for the July 2020 CSEC exams. If you've missed any of the previous videos, I'm going to put a card up there and a link in the description below so you can check out the entire playlist. This video will focus exclusively on bank reconciliation statements. Unfortunately, I do not have another video that explains that topic by itself, so I'm going to have to do a bit more explanation in this video. And coupled with the fact that it's 30 questions long, it may take a little time. So with that being said, let's get into the questions now. All right, so number one, let's take a look. When is a bank reconciliation statement used? Okay, so a bank reconciliation statement is used when the bank balance in the cash book does not agree with the bank statement balance. What is a bank statement? So cash at bank literally is at the bank. We don't have that cash on hand on our premises. It's at a commercial bank. So the bank now has a responsibility to keep track of the inflows and outflows to our account of our money. And they will send us that report. It might be sent as a hard copy, but nowadays they're sending electronic copies. Well, when you log into your account online, you'll see it there. So sometimes the bank balance in the cash book doesn't agree with the bank balance in the bank statement. And that is when we use a bank reconciliation statement to show that we know why the balance in the cash book does not agree with the balance in the bank statement. Cool. So let's see. When there are errors in the cash book, no. When the bank column of the cash book does not agree with the cash column, no. When the bank balance in the cash book agrees with the corresponding balance in the bank statement, I feel like that's not the right answer. And when the bank balance in the cash book does not agree with the corresponding balance in the bank statement, that is definitely the answer. So let's put that one in yellow so we could know which one is the correct answer. Okay, let's go down to number 2. So what is the main reason why the bank balance in the cash book would differ from the corresponding balance in the bank statement? So let me tell you one time and then we'll take a look in the options. So when we keep track of our money in the cash book, we will sometimes get information that the bank will not get. Because remember, we will get checks, we might also write checks and pay people, but it takes time for those checks to reach the bank. So we will know things the bank won't know. Also, sometimes transactions happen on the bank side that we don't know about until we get the bank statement or we check our online banking. For example, let's say a customer went to the bank and put a check in our bank account instead of bringing the check to us first. Or let's say they use their internet banking to make a transfer to our bank account from their bank. It wouldn't pass through us, so our cash book wouldn't have it. So there's information we have in the cash book and information the bank has in the bank statement. And most times those things aren't symmetrical. The information is not symmetrical. So this is what you call asymmetric or asymmetric information. So they have errors in either the cash book, the bank statement, or both. Well, I mean, that could be a reason. Yes, but the best answer here, well, is the one I wanted it to be. Asymmetrical or asymmetric information. Let's do asymmetric information. I don't think asymmetrical is a word. I could be wrong. Omissions in either the cash book, the bank statement, or both. That could be a reason, and they are supposed to differ as they keep track of different items. No, this one is definitely wrong. This one could be correct, but it's not as holistic as it should be to be a proper answer. Okay, moving on to question 3. What are some of the items that would cause the bank balance in the cash book to differ from the corresponding bank balance in the bank statement? Okay, so this is where some of y'all who may be familiar with bank statements would probably be able to read the answer. There are certain keywords, and actually I put it as option A: unpresented checks, bank charges, standing orders, bank lodgements. All right, so these are some of the items. So I will be explaining each of these items as we go along. Expenses, revenues, provisions, and drawings, definitely not. That's kind of like income statement and balance sheet stuff. Changes in the values of assets, liabilities, and capital. That's once again balance sheet items. And these balances are supposed to differ as these items keep track of different sets of information. No, that is definitely not correct. So unpresented checks, bank charges, standing orders, bank lodgements. Once again, as I mentioned, I will be explaining in detail what those things are as we go down in the questions. Okay, so let's go back up and let's go across to question 4. Which of the following sets of items would be found in the cash book but not in the bank statement? So like I mentioned before, sometimes we, as in the company who's keeping track of the cash book, will get things that the bank won't get. So what do we call it? So for example, we may pay out checks, we may write checks and pay out to whoever provides us with goods, services, utilities, etc. And sometimes we'll get checks from customers. Now, the thing is, those checks sometimes take time to get to the bank. So if, for example, we get a check and we don't carry it to the bank to deposit it, that's an undeposited check. If we do carry it and we put it in, there's a processing time. It takes about 5 days for that check to clear, to go through all the processing, and for the money to be transferred from that person's account to our account. So that's called a bank lodgement. And then finally, when we pay somebody a check, if they don't carry it to the bank or they don't present it to the bank, for our bank to pay them, that's called an unpresented check. So let's look for so that's option D, unpresented checks, unpresented checks. Unpresented checks, bank lodgements, and undeposited checks. Everything else here, bank charges, Nsf checks, direct deposits, all that stuff would be in the bank statement, but not in the cash book. Contra entries, discount allowed, drawings, now those things would be in the cash book. And you might think, oh, well, that's cash book stuff, so it's not in the bank statement. That might not necessarily be correct. So be careful. Interest received, credit transfers, standing orders, those things will be in the bank statement. Okay, so which of the following sets of items would be found in the bank statement but not in the cash book? All right, so let's take a look. So bank statement wise, actually, you know what? I want to scroll back up a little bit to number 4, because there are quite a few things there that would actually be in the bank statement but not in the cash book. So first of all, bank charges. So the bank charges us money for keeping our money safe, and they will deduct it directly from our account. So we probably won't know about it unless and until we get the bank statement or we log onto the internet banking and get the information. Nsf checks. Nsf stands for not sufficient funds. So that specifically refers to when the person's account doesn't have enough funds to honor the check. It's also sometimes called a bounce check or a return check. But return checks are a bit more holistic. That could be if they have the wrong date. If, for example, it's 2020 now and somebody put 2019 or 2021, the bank can't honor the check. Or if they don't sign it properly or at all, because checks are supposed to be signed in order for them to be honored. All right. Now, direct deposits. So in this day and age of internet banking, we can do an online transfer. So money will go directly from one person's account to another person's account. And there's no need for the money to physically change hands or for checks to be written and exchanged. So what would happen is that information would be on the bank side, but not on our side for the cash book. Now, interest received, that is when the bank rewards us for keeping our money with them. And it would be credited directly to our account at the bank, and we will only know about it if and when we check the bank statement or online banking. Credit transfers. So credit transfers, well, that actually is a more apt phrase for what I just explained about the transfers via the internet. Direct deposits are actually more kind of like when people go to our bank and put money in our account directly, as opposed to bringing a check for us. All right. And a standing order. So a standing order, that is when we set up an automatic payment with the bank, and the bank pays whatever. It could be insurance, it could be rent, it could be all sorts of things, repayment of a loan, etc. So what would happen is that money comes directly out of our bank account, and we hopefully would have a note somewhere in our records for us to make that entry in the cash book. But if we don't, when the bank statement comes, or if we log online and check the online banking, we will see that money coming out, and we will say, hey, I have to put that payment in my cash book. So those are some items that will be in the bank statement, but not in the cash book. So if we scroll down to number 5, or maybe it's possible for me to show you both 4 and 5. So let's see, which of the following sets of items would be found in the bank statement but not in the cash book? So bank charges and direct debits. So bank charges, we just said yes, the bank takes that out of our account automatically. A direct debit, but we didn't see that up above, but it's like the opposite of a direct credit or direct deposit. Instead of somebody putting money in our account, it's like we make an online transfer out, or there was somebody we gave permission to deduct money from our account. We talked about direct credit transfers and standing orders just now. We also talked about interest credited to the bank account and Nsf checks. So the answer here is actually all of the above. Okay, let's scroll on to number 6. So what is the correct sequence of events when constructing a bank reconciliation statement? So we are supposed to update the cash book first for information the bank statement has that the cash book does not. And then we do the Bankrec. So update cash book, prepare Bankrec. Yep, that's it there. All right, so number 7, why in the bank statement are debit items decreases and credit items increases? All right, this is one that confuses people every year. So the bank statement is the bank's records of our money with them. Whose money is it? Our money. Who has physical possession? The bank. Is it the bank's money? No. So our money at the bank is the bank's liability. And what are your double entry rules for liabilities? Credit to increase, debit to decrease. So that's what we're going to look for. So it is a record of our money at the bank, which the bank will classify as a liability. All right, so what? Debit items are actually increases and credit items are actually decreases. No. Our money at the bank is our asset. That is correct. That is perfectly true, but that doesn't answer the question. None of the above. Well, no. Okay, so let's scroll down and let's go across to number 8. So which of the following is true when updating the cash book? Okay, so it's cheese in Spanish. Sorry. So unpresented checks are debited. So first of all, hold on, before I get into it, when we are updating the cash book, that means that we are putting items in the cash book that the bank statement has, but the cash book does not. So we had a whole list of stuff above. Do you guys remember what it is? You want to take a rewind and check it out? Well, hold on. Before we go there. So let's just scroll back up a little bit and check out those items. So we had quite a list, right? So we had bank charges, direct debits, direct credit transfers, standing orders, interest credited, Nsf checks, and we had some stuff up here too. Now, this is how you have to think about it. What would happen to the bank, what would happen when these items are entered in our cash book? Will they cause increases or decreases? And to know that, ask yourself, well, what effect did they have on the bank statement balance? Did they increase or decrease the bank statement balance? Right? So this first one says unpresented checks are debited. That's a trick because unpresented checks are not used to update the cash book. They are used to do the bank reconciliation statement. Bank charges are entered on the credit side. So bank charges, that's when the bank deducts money from our bank account. That means the balance is going to come down, which is a decrease. And a decrease, if we had to enter a decrease in our cash book, well, bank is an asset. To record a decrease in an asset, you have to credit the asset account. So that actually, that actually is true. This is another trick one here. Bank lodgements are actually used to do the bank reconciliation statement. And standing orders are entered on the debit side. So a standing order, that's when the bank makes an automatic payment as per our request. And if they have to do that, it will cause money to come out of our account, which causes the balance to go down. So that's a decrease in an asset, which would require a credit to the cash book. So that's also not correct. Okay, let's go down to number 9. Which of the following is false when updating the cash book? Okay, so which is not true? So standing orders are entered on the credit side. Well, that is true because once again, I just said standing orders are when the bank makes a payment on our behalf, so money would come out of our account. So when we have to record it in the cash book, it's a payment. It goes on the credit side. Nsf checks are entered on the credit side, right? So Nsf checks, that is when checks bounce. So when we got the check initially, we would have put it on the debit side, or whichever side is debit for you. And when we send it to the bank, and the bank goes through its process and realizes, hey, the person who wrote this check doesn't have enough money in their account to cover it, we have to send it back to our customer, who will then go to this person and tell them, hey, you don't have enough money to pay me. So ultimately, we actually did not get the money. So that debit that we would have in the account would not actually be valid. So we can't really go and erase it, right? I mean, I know in this day and age of technology, we can maybe just delete it, but we need to show every transaction as it happens and keep it there. So if we have a debit that is there, but we have to negate it, we have to go on the opposite side of the T account, which requires a credit. So this actually is true, it's not false. Direct credit transfers go on the credit side. So a credit transfer is when somebody sends money to our account, which will cause the account to increase, and increases in our account require a debit to the cash book. So this is the one that we have to highlight. Bank charges are entered on the credit side. So bank charges are deductions from our account, which is a decrease, and a decrease when entered in the cash book will go on the credit side. So that is correct. Okay. So which of the following is debited when updating the cash book? So debited to the cash book means it's an increase. So bank charges is a decrease, Nsf Checks is a decrease, this is an increase, but we can't have two decreases and an increase. So let's see. Next, direct credit transfers, yes. Bank charges, no. Interest received, yes, but we have one item that shouldn't be there. Let me just fix this real quick. Cool. Standing orders, that's a payment, so yes. So no, sorry, so that is definitely not debited. Nsf Checks are also not debited. Direct deposits are. So by process of elimination has to be D. So direct credit transfers will increase our account. Interest received will increase our account. And direct deposits will also increase our account. So all three items here will increase our balance, which will require a debit when entered in the updated cash book. Okay, let's check out number 11. Which of the following are credited when updating the cash book? Okay, so credits to the cash book are done for decreases to the cash book. So let's take a look. So payment items. So interest received, that already says, no, that's money coming in, that's an increase. The other two items are decreases, but 2 out of 3 won't cut it. Direct deposits, that's money coming in, so no. Nsf Checks will cause a decrease, but interest received is also an increase. Nsf Checks, yes. So remember, Nsf Checks are not sufficient funds. That's a bounce check. So it undoes a receipt. So it undoes a debit by being entered as a credit item. Bank charges also decrease the account, so that'll be a credit item too. And standing orders are automatic payments set up at the bank, which means will cause our account to decrease. So all three items here will be credited when updating the cash book. This last item has direct credits, which will increase the cash book, so that one is out. Let's check out number 12, shall we? So scroll across. So what is an unpresented check? So I explained all this already, so maybe I should have thought about my sequencing beforehand, but I think maybe hearing it again might reinforce it for those who may be having trouble. Just a bit of history. I sucked at bank reconciliation statements in Form 4, 5, and 6. I didn't even see it in Form 6. Only when I went to university, and not to say that it was a university level topic, it was in the intro to accounts, which is like Form 4 accounts in university again. And the textbook there explained it brilliantly. So simply, it is actually very simple. And when I do my video, I will link it below. So if you are watching this after July, August 2020, check the description. If it's not there, message me on Instagram, Facebook, TikTok, Twitter, and wherever else I am and tell me, Chris, do the Bankrec video. If it's not after July 2020, don't message me about it yet. I have real things going on. All right. So an unpresented check is a check we write to make a payment for something. We give the check to whoever gave us a good or service or benefit, and that person is supposed to carry that check to their bank in order to receive payment from us. If they don't carry the check, if they don't present the check, then they can't get the money. So that's what an unpresented check is. So a check used to pay for something, but which has not yet been presented to the bank. Okay, what are the other options? Amounts paid on our behalf by the bank. That's a standing order. Amounts paid to us by the bank on our account balance at the end of the month. That is interest received. Checks we deposited, but which the bank has returned because of an issue on the payer's side. That's the return checks. It could be Nsf Checks, but that is specifically with respect to not enough or not sufficient funds. Let's check out number 13, shall we? What is a bank lodgement? Okay, so let me explain this again. So when we receive a check from a customer, paying us for goods or services or whatever, we will carry that check to the bank and put it in the ATM or go by the teller, etc. I know in other countries you can take a picture of that check and send it to your bank and they'll put the money in your account. Now, The thing is, at least in Trinidad, there's about a 5-day waiting period for that check to clear. By clear, I mean you carry it to the bank, you put it in the ATM or carry by the teller. They have to go through a whole process with the clearing house and all this kind of. I'm not going to get into all. I don't even know all the details, to be honest, right? But I know it takes 5 days. So until that check clears, we will not see that money on our bank statement or on our online banking. You might see something, a current balance and an available balance. So the current balance might have it, but the available balance will not, because the money hasn't come yet, so it's not available. But they will show that it's pending. So that's what a bank lodgement is. So checks used to make payments, but which have not yet been presented to the bank. No, that's unpresented checks. Checks received and deposited, but which have not yet been processed by the bank. Yep. Amounts sent directly to our bank account by customers. No, that's direct transfers, direct credit transfers. Amounts paid on our behalf by the bank. That is standing order. Okay, let's go again. What is an undeposited check? Well, that is exactly as it sounds. The check we have received but have not yet carried to the bank to deposit. So a check we have received but have not yet carried to the bank to be put in our account. Let's go. Number 15, halfway there. What is an Nsf check? So Nsf stands for not sufficient funds. So amounts paid on our behalf by the bank, standing order. Amounts paid to us by the bank on our account balance at the end of the month, that's interest received. A check used to pay for something but which has not yet been presented to the bank, that is unpresented checks. Checks we deposited but which the bank has returned because of an issue on the payer's side. Well, that should really say because the payer does not have sufficient funds in his or her account. But we'll leave it for now. Okay. Now let's scroll down and go across to number 16. Which of the following statements is true regarding the preparation of a bank reconciliation statement? So let's see if we know our stuff. It must start with the cash book balance before the cash book is updated. That is definitely wrong. If you're doing a cash book, if you're doing a Bankrec, updating the cash book is the first thing you have to do. Wait, is my hair hanging on? Weird. I know making up my hair kind of giving trouble. Sorry, so that one is definitely out. It must start with the cash book balance after it is updated. That could be true. It must start with the bank statement balance. That could be the option. It can start with either B or C. Yes, that is correct. So what actually made B or C incorrect was the word must. It has to start with one or the other, but to say it must start with the cash book balance or it must start with the bank statement balance, wrong. It must start with either one or the other. All right. Okay. And that's the thing. A lot of times people in my class when I'm teaching say, well, Miss or Sir taught us this one way, but you're showing us something different. And that's the beauty about accounting. Sometimes in certain things, there are different ways to do things, just like with math. All right. And the bank reconciliation statement is not a financial statement. It is not governed by any accounting standards, international financial reporting standards, anything like that. So there's no one right way to do it. If, however, you only have information from a certain side, there may only be one possible way to approach it. Okay, let's take a read of number 17. So when preparing a bank reconciliation statement, what items are usually used? So Bankrec, so that's the undeposited checks, unpresented checks, and bank lodgements, which is option B. All right, so whether you start with the cash book balance or the bank statement balance, these are the items that have to go in the Bankrec. All of the others, everything else there, will go in the updated cash book. Let's go to number 18. So how do we treat with unpresented checks in the bank reconciliation statement? So unpresented checks, now you see, the thing is, it depends. Are we starting with the cash book balance? Are we starting with the bank statement balance? It depends. So to say they are always added or always subtracted, no. It depends on whether we start with the updated cash book balance or the bank statement balance. Look at these. They are not used in the Bankrec. So you have to know, you have to know your stuff. Okay. So number 19, how do we treat with bank lodgements in the bank reconciliation statement? Once again, it depends. What balance are we starting with? So let's go with C again. It depends on whether we start with the updated cash book or the balance in the bank statement. Okay, let's go to number 20. So how do we treat with undeposited checks in the Bankrec? Once again, it depends. So that's the answer here. Boom. How do we treat with Nsf checks in the Bankrec? Well, that's a trick. See, they have you going with these three things in a row above, but those are the only three things that actually, no, that's not entirely correct. Those are the three major things that will go in the Bankrec. So they are to be used to update the cash book and are not used in the bank reconciliation statement. That I'm going with that answer because that is at least the conventional one, and that is probably what you will have to answer. If a bank reconciliation statement starts with the bank statement balance, the correct treatment of the following items is, okay, so here you might want to take some notes. I mean, I hope you're taking notes all the time, but especially here if you have a Bankrec to do. So we have bank lodgements, unpresented checks, and undeposited checks. So with bank lodgements, that's money we deposit, but the bank has not yet processed it, so it hasn't yet hit our account. So when we deposit money in the bank, our bank balance is supposed to go up. So when we adjust the Bankrec for this, if we start with the bank statement balance, we are going to add it. All right, so option B is out because that says -1, right? So add A, add 1, add 1, add 1. So A, C, or D. Unpresented checks. That's when we write checks to cut to people who we have to pay, but they have not yet carried that check to the bank. They haven't presented it for payment, so our money hasn't come out of our account as yet. So the bank statement won't reflect that outflow. So what we have to do if we have to reconcile is we have to subtract that amount. So we have to say minus. Okay, so it looks like this is the answer. And let's just check out 3 undeposited checks, right? So undeposited checks are basically the step before bank lodgements. We haven't carried the check to the bank to deposit, but we've gotten a check. So technically we've gotten money, we just don't have access to it. So we're going to add that one as well. Oops. Okay, so let's highlight this item here. All right, so before we scroll down, just know, if you guys have any questions about any of these things, please feel free to leave that question in the comment section below. I'll be happy to answer it. Let's scroll down to 23. So we're almost home free here. We have just about 8 questions to go. Now we have some calculations. All right, so using the information, in the table below, answer the question that follows. So we have a cash book balance, bank charges, and direct deposits. So what is the correct working of the updated cash book balance? So bank charges are amounts the bank deducts just for taking care of our account. So we'd have to minus the 20. And direct deposits are when people put money in our account directly. So that's going to increase. So we're going to have to minus, so it'll be 1,500 minus 20 plus 200. 1,500 minus 20 plus 200. Let's scroll down to number 24 and see what we have. So same setup, cash book balance, standing order, direct deposit, bank charge. What is the correct working of the updated cash book balance? Right, so a standing order is a payment the bank makes on our behalf and deducts the money directly from our account, which means it's a decrease. So we're going to have to minus 1,500. Direct deposits, we just saw it above, money put into our account. So we have to add the 4,000. And we dealt with bank charges just now, we have to minus that. So we're going to go minus plus minus. So minus, 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 minus plus minus. There we go. Okay, let's scroll back up and let's go across to number 25. Using the information in the table below, answer the question at 4. Okay, so same thing. Cash book balance, standing order, Nsf checks, bank charges, direct deposits. So what is the correct working of the updated cash book balance? Okay, so we said standing orders are automatic payments from our accounts, so we have to subtract that. Nsf checks are checks the bank returned because they weren't able to get the money. So we actually have to subtract Nsf checks because when we got the check, we would have put it on the debit side to show an increase, but we didn't actually get the money. So we have to undo the debit, and to undo the debit, you have to credit, which means minus. So we have minus minus, bank charges is also a minus, and direct deposits is an addition. So minus 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 plus, which looks like option, nope, not that one at all. There you go, minus 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 plus. All right, so cash book balance, standing order, direct deposits, Nsf checks, direct credit transfers, bank charge. Okay, so what's the updated cash book balance? How do we calculate? So we're going to minus the standing order. Direct deposits is added, minus Nsf checks, add direct credit transfers, minus bank charge. So minus plus, minus plus, minus. So minus plus, minus plus, minus. All right, once again, I'd like to take this opportunity to tell you, if you have any questions, please feel free to leave it in the comments below. You can always rewatch the earlier parts of the video with the explanations. All right, but please feel free to message me if you need my help. Happy to help once I have time. Okay, using the information in the table below. Okay, so, bank statement balance. What's going on here? Unpresented checks, bank lodgement. So what is the correct working for the bank reconciliation statement? Okay, so our bank statement balance, if we have unpresented checks, so check it, bank statement, cash book. If we write checks to make payments, our cash book is going to go down. Until those checks are presented, the bank statement balance will not go down. So when you're doing the Bankrec, to kind of show we know that they differ, or show that we could get back the cash book balance from here, we will minus the unpresented checks. Basically, remember what we're trying to do with the Bankrec is we're trying to show that we know why both balances differ. And what we are doing, remember we talked about asymmetric information earlier. So basically we're trying to create symmetric information. So what would happen to the bank statement balance if and when these things hit the bank statement balance? So once again, cash book, bank statement. If we make a payment with a check, the cash book comes down. Until those checks are presented, this does not come down. So when we're doing the Bankrec, we have to imagine that those checks hit the bank statement. So it's going to come down. So you have to minus unpresented checks if you're starting with the bank statement. Now, bank lodgements, that's when we get money, so our cash book is going to go up. We're going to deposit the money in the bank, But until that money clears, until the checks are processed, the bank statement balance is below. So to show what happens if and when those checks actually hit the bank statement, we're going to have to add. All right? So we're doing minus 14 plus 12. 37 minus 14 plus 12. All right. 28. So bank statement, undeposited checks, unpresented checks, bank lodgements. Okay, so we talked about unpresented checks already. We talked about bank lodgements already. What about undeposited checks? That's basically the same treatment as for bank lodgements, So when we get a check, the cash book goes up. Until that check is deposited in the bank and it's processed and cleared, the bank statement is not going to go up. So in order to show that we know why these two differ, we're going to have to add the undeposited checks here. Remember, what we're trying to do is we're trying to show what would happen if all the information in the cash book enters the bank statement. And if that's the case, if it's undeposited checks, this is going to go up. So we're looking for add this, minus that, add. So plus minus plus. So plus minus minus plus minus, plus minus plus. Okay, last two questions. So number 20, let's scroll across to number 29. Okay, we're starting with the updated cash book balance. Unpresented checks, bank lodgements. What is the correct working for the bank reconciliation statement? Right, if you start with the cash book balance, you have to do the opposite of what we just talked about. Remember, with the bank reconciliation statement, we are trying to create a situation where we have symmetric or symmetrical information. What that means is that the information between the cash book and the bank statement, that has to be the same. So when we started with the bank statement balance, it's almost like we were updating the bank statement just like we updated the cash book. We're not actually updating the bank statement because we have no control over it, in a manner of speaking. When we do the Bankrec and we start with the cash book balance, check what has to happen. So Unpresented checks, let's start there. So when we make a payment, the cash book balance is going to go down. The bank statement balance hasn't gone down yet until those checks are presented. So right now, this is the situation. To make these two equal, we either have to minus the unpresented checks, like we did in the previous thing if we started with the bank statement balance, or we add it back to the cash book. Now, why are we adding it back to the cash book? Because we are trying to create a situation where these two things have the same information. If we have a deduction here, but not here, in order to make them the same again, we either have to subtract it from the bank statement or add it back to the cash book. So because we are starting with the cash book balance, we add it back. Bank lodgements, once again, that's when we deposit checks in the bank, so the balance. So cash book wise, we got a check from a customer, boom, increase. Until that check is deposited and it clears, this doesn't move. So if we are trying to get these two back to be the same, we either have to add it here to the bank statement, which we did before, but because we are starting with the cash book balance, we have to kind of undo that, which means we're going to have to subtract. So once again, this treatment is the exact opposite of what happened in number 27, if you want to go back and check it again. So we're going to start with 26, add unpresented checks minus bank lodgements. That's this one. Add 3,000 minus 1,000. And number 30, so last question. So updated cash book balance, bank lodgement, unpresented checks, undeposited. What is the correct working for the Bankrec? Okay. So we're going to start with 54. Bank lodgements, we said we're going to subtract because they represent increases in the cash book that are not here. So to make them level again, we minus them because we are starting with the cash book balance. Unpresented checks, we said we're going to add those back because cash book wise, when you write a check, it comes down. Unless the check's clear, unless the payees carry the checks to the bank, money it's not going to come down. So we have to add it back to the bank, to the cash book balance, by the way. And undeposited checks, right? So we got money, we got checks, cash book went up, but the bank statement is not reflected here yet. So if we were starting with the bank statement balance, we would add it to show, well, what would happen when the checks finally reach? But the checks didn't reach yet. So what we have to do to kind of equate them again is subtract them from here. Boom. Okay, guys. So that, oh, sorry, I have to, right. So we're going to subtract that, add that, and subtract this. So minus plus minus, I think that's A. Alright guys, so thank you so much for watching. If you want to see the entire playlist of these multiple choice questions, I'm going to put a card there. If you want to see what I did last year on the Bankrec questions, I'm going to put another card there. And as per usual, don't forget to like, share, and subscribe somewhere around there. And I will see you guys next time. Later.